Stop everything you're doing right now, put your phone down, close every other tab, turn off the TV, because what I'm about to reveal to you, what's happening right now in January 2026 behind closed doors at the world's largest financial institutions, will fundamentally change how you view the silver market forever. My name is William Lee. I'm 33 years old, and today I'm going to tell you the truth that nobody else is willing to say out loud. The truth that your broker is deliberately hiding from you, the truth that the mainstream financial media has been instructed not to report, the truth about what BlackRock is doing right now with silver, and why major American banks are closing their short positions at massive losses, something they never do. Before we go any further, I need to ask you something important. Have you been watching the markets for years? Have you seen cycles come and go? Bull markets, bear markets, crashes, recoveries. Have you heard every prediction under the sun? Because what I'm about to show you is not a prediction. This is pattern recognition. This is documented evidence. This is real-time institutional behavior that reveals everything. So do yourself a favor right now. Hit that subscribe button. I know everyone asks for subscriptions, but here's the difference. I don't waste your time with hype. I don't sell you dreams. I give you data, documented evidence, and strategic warnings. The kind of information serious investors actually need. Subscribe and turn on notifications, because what happens next in the silver market will determine who preserves wealth and who loses everything. And one more thing before we dive in. Drop a comment below and tell me, where are you watching from? United States, Europe, Asia, Latin America? Let me know, because what's coming affects everyone everywhere. But how it affects you, how you should position, depends on where you are and what your situation is. Now let's talk about what BlackRock just did and why it should make you pay very close attention. January 2026. While the financial media fills your screen with noise about stock market rallies and economic optimism, something extraordinary is unfolding in the marble corridors of the world's largest asset manager, BlackRock. The firm that manages over $10 trillion in assets, the firm that moves markets with a single decision, the firm that has more financial power than most countries, is accumulating silver. Not small amounts, not token positions, not speculative allocations, massive institutional scale accumulation of physical silver and silver-backed securities. We're talking about billions of dollars flowing into silver positions. And they're doing it quietly. No press releases, no announcements, no fanfare, just steady, relentless buying day after day after day. But here's where it gets absolutely wild. At the exact same time BlackRock is accumulating, major American banks, the institutions that have manipulated silver prices lower for decades through massive short positions, are closing those shorts, and they're not waiting for profitable exits. They're closing at losses, massive losses. Banks that never use stop losses, banks that typically hold positions until they're profitable, banks that have bottomless pockets and infinite patience, they're panic closing their silver shorts and taking the hit. Let me be very clear about what this means. Banks don't close losing positions unless they absolutely have to. Banks don't take losses voluntarily. Banks have algorithms, risk management systems, access to Fed liquidity. They can hold losing trades indefinitely, waiting for reversals. But right now, in January 2026, they're closing silver shorts at losses. Why? Because they've realized something terrifying. Silver is not coming back down. Or if it does pull back, it will be small, temporary, and nowhere near their entry prices. These banks shorted silver at 22, 24, 26 Rs thinking it would go back to 18s. They added to shorts at $30, $35, $40 convinced the rally would fail. They doubled down at $50, $60, $70, absolutely certain the manipulation would work one more time like it always had before. And now silver is at $90 heading to $100, and they're trapped. Their positions are hemorrhaging money. Their risk managers are screaming. Their models have broken. And they're realizing that if they don't close now, the losses will be catastrophic. So they're buying frantically, desperately. Closing shorts means buying physical silver or silver contracts to offset the positions. And when banks with billions in short exposure start buying to close, that creates massive upward pressure on price. It becomes a self-reinforcing cycle. Price rises, shorts lose more money, risk limits get hit. They're forced to buy more. Price rises further. The squeeze accelerates. And here's the part that should make you furious. Here's the part that reveals just how corrupt and broken this system is. While these same banks are panic buying silver to close their losing shorts, their retail broker divisions are calling you, yes you, the individual investor who bought silver at $30 or $50 or $70, and they're telling you to take profits. They're telling you silver is overextended. They're telling you a correction is coming. They're telling you to close your long positions and lock in gains. Why would they do this? Why would banks tell retail investors to sell the exact asset the bank itself is desperately buying? Because they want your silver. They want your positions. They want to scare you out of your long so they can take them. They want you to sell at $90 so they can buy what you're selling to close their shorts. They're using their relationship with you, their position of trust as your broker, to manipulate you into giving them the exit liquidity they desperately need. This is not conspiracy theory. This is not speculation. This is standard institutional playbook. Create fear in retail. Use your media connections to spread negative narratives. Have your broker division call clients and suggest taking profits, all while the institutional desk is buying as fast as possible. They're trying to shake you out before the real move begins. They're trying to steal your position before silver goes to $150, $200 and beyond. Let me walk you through exactly what's happening and why, because once you understand the mechanics, you'll never trust the financial system the same way again. BlackRock manages over $10 trillion. That number is so large it's difficult to comprehend. It represents retirement savings for hundreds of millions of people worldwide. Teacher pensions, firefighter funds, the collective wealth of multiple generations. BlackRock doesn't gamble, they don't chase memes, they don't follow retail sentiment, they move based on deep institutional analysis, on decades of market experience, on models that process more data than any human could analyze in a lifetime. And right now, those models are screaming one thing: buy silver. Not as a speculation, not as a trade, as a strategic allocation, as portfolio insurance, as protection against what's coming next in the monetary system. BlackRock is not buying silver because they think it might go up. They're buying silver because they've calculated that in the environment we're entering, silver is one of the only assets that will maintain purchasing power. But BlackRock's buying is only half the story. The other half, the part that's creating the explosive upward pressure we're seeing, is the banks closing shorts. Let me explain how this works because it's critical to understanding why silver is moving so violently. For decades, a handful of major banks, primarily American banks, some European, have held massive short positions in silver. These weren't hedges. These weren't legitimate market-making activities. These were naked shorts, positions designed to suppress price, sell silver you don't have, create artificial supply, drive the price down, cover the shorts at lower prices, profit, repeat. It worked for years. It worked because the banks had more capital than anyone else. They could outlast any rally. They controlled the narrative through financial media connections. They had access to Federal Reserve liquidity if needed, and most importantly, they believed silver would always come back down because it always had before. Industrial demand was steady, but predictable. Investment demand was minimal. Nobody cared about silver. It was a dead market they could manipulate at will. But something changed in 2024-2025. Multiple forces converged simultaneously that broke their model. China started accumulating aggressively, not as a trade, as strategic policy, buying hundreds of millions of ounces regardless of price. India's import demand exploded as their economy grew and their middle class sought inflation protection. Industrial demand surged as solar panel production accelerated. And most importantly, Basel III banking regulations went into effect, making it expensive to hold naked short positions. The banks tried to maintain their shorts anyway. They believed this was another temporary spike like 2011 that would fade. They added to positions thinking they could force a reversal through margin hikes and media campaigns. But it didn't work this time. Silver kept rising. $50, $60, $70, $80. Their losses mounted. Their risk managers started warning. Their internal models started flashing red. And then silver hit $90, and something broke psychologically. At $90, with silver making all-time highs and showing no signs of slowing, the banks realized they were wrong. Completely, utterly, catastrophically wrong. They realized they weren't fighting retail speculators or momentum traders they could scare out. They were fighting sovereign nations with unlimited resources, fighting industrial users with inelastic demand, fighting a physical shortage they couldn't manipulate away with paper contracts, so they started closing. Not all at once. Not with public announcements, but systematically, day after day, buying physical silver and silver contracts to offset their shorts. And this creates enormous upward pressure because short covering is forced buying. They have to buy regardless of price. They can't wait for dips. They can't be patient. Every day they stay short, they lose more money. Every uptick in price hits their P&L. The pressure to close intensifies. This is what's driving silver from $85 to $90 and beyond right now. Not retail FOMO, not speculative excess, institutional short covering combined with BlackRock accumulation, the smartest money in the world buying while the dumbest shorts, the banks who manipulated too long, are forced to buy to close. It's a perfect storm of bullish pressure. Now here's where it gets personal. Here's where it affects you directly. Your broker calls you. Maybe not today. Maybe not this week, but if you hold silver positions, especially profitable ones, they will call eventually, and they'll use sophisticated psychological tactics to convince you to sell. They'll say, "Congratulations on your gains. Silver has had an amazing run, but don't you think it's time to take some profits? Lock in the win. Nobody ever went broke taking profits." Sounds reasonable, right? Sounds like good advice from someone looking out for your interests. But ask yourself, if silver is so overextended, if a correction is so imminent, why isn't the broker shorting it? Why aren't they putting the bank's money where their advice is? Because they know what's really happening. They know their own bank is buying, not selling. They know the institutional desk is accumulating while the retail desk is trying to scare you out. They'll say, the momentum indicators are overbought. The RSI is at 80. Every technical signal says silver is due for a pullback. Why not sell now and buy back lower? Again, sounds technical, sounds analytical, but technical indicators don't matter when you have sovereign nations and institutional giants buying unlimited quantities. Technical analysis assumes normal market behavior. This isn't normal market behavior. This is a paradigm shift. They'll say, don't be greedy. You've already made 50%, 100%, 200% on this position. The smart traders take profits and move to the next opportunity. This is pure psychological manipulation. They're trying to trigger your fear of giving back gains. They're trying to make you feel greedy for wanting more. But the reality is, silver isn't expensive at $90. Silver at $90 is still dramatically undervalued relative to its monetary role, its industrial necessity, and its supply constraints. So what should you do when your broker calls with these suggestions? First, ask them a simple question. Is your institutional desk buying or selling silver right now? They won't answer honestly. They'll deflect. They'll say they can't discuss institutional strategies. But their evasion tells you everything. If the bank was selling, they'd tell you proudly to support their case. Second, ask yourself why you bought silver in the first place. If you bought it as a trade, as a speculation, hoping to make a quick profit, then maybe taking some profits makes sense. But if you bought silver as protection against currency debasement, as insurance against monetary system failure, as a store of value during transition, then nothing has changed. The reasons you bought are more valid now than ever. Third, understand that this is not the end of the silver rally. This is the beginning, the acceleration phase. Silver at $90 is heading to $100, then $150, then $200, and potentially beyond. Not because of speculation, because of mathematics. Because industrial demand exceeds mine supply, because sovereign accumulation is relentless, because the bank's short covering will continue for months, because the monetary system is breaking down exactly as historical patterns predict. Let me share some critical numbers so you understand the scale of what's happening. Global silver mine production is approximately 850 million ounces per year. That's total supply from every mine on Earth. Industrial demand alone, just the silver consumed in electronics, solar panels, batteries, medical applications, is approximately 600 million ounces per year. That leaves 250 million ounces for investment demand, jewelry, and sovereign purchases. But investment demand has exploded to 400 plus million ounces per year. India is importing 300 plus million ounces annually. China is buying 200 plus million ounces per year. The US military consumes 45 million ounces per year and is stockpiling more. Add it all up, and you get total demand of 1.5 plus billion ounces against supply of 850 million ounces. That's a structural deficit of 650 plus million ounces per year that cannot be solved without dramatically higher prices. Where does that missing 650 million ounces come from? It comes from above-ground inventories, silver that's stored in vaults, held by investors, accumulated over decades. But those inventories are finite, and they're being drained rapidly. At current consumption rates, available above-ground inventories will be exhausted within 3 to 5 years. After that, there's no buffer. Either demand gets destroyed through much higher prices, or industrial users can't get metal and production halts. This is why BlackRock is buying. This is why banks are closing shorts at losses. This is why your broker is lying to you. Because the people with access to real data, real models, real institutional intelligence, they see what's coming. They see a world where silver at $200 and $300 is not expensive. It's necessary. It's the clearing price where supply finally equals demand. Now let me address something very important because I don't want anyone making financial decisions based solely on what I'm saying. I need you to be responsible. I need you to be smart about this. Silver is volatile. It can drop $10 in a day just as easily as it can rise $10. There will be corrections, there will be moments of panic, there will be times when it feels like selling is the smart choice. Only invest amounts you can afford to lose completely. Do not use leverage unless you fully understand the risks and can handle the volatility. Do not put money you need for rent, food, or emergency expenses into silver. Do not mortgage your house to buy silver. Do not drain your retirement accounts. Be responsible, be measured, be smart. But also understand what responsible positioning means. It doesn't mean staying in cash while the currency devalues. It doesn't mean trusting bonds while the government debt spirals out of control. It doesn't mean believing your broker when they tell you to sell the asset they're desperately buying. Responsible positioning means allocating a portion of your wealth, the portion you can afford to hold long term, into assets that preserve purchasing power during monetary transitions. For most people, that probably means 10-25% of investable assets in physical precious metals, not paper ETFs, not mining stocks, though those can be part of a strategy. Physical metal you can hold, store securely, and access without counterparty risk. Silver coins, silver bars, allocated storage with reputable vaults. Real metal, not promises. Let me paint you a picture of what I think happens next, because pattern recognition based on historical precedent is powerful. We're at $90 right now in January 2026. The short covering pressure will continue for weeks, possibly months, as banks systematically close positions. That alone could drive silver to $120, $130. At the same time, the physical shortage is intensifying. Premiums on coins and bars are already $10, $15 over spot. That spread will widen to $20, $30 as retail panic buying intensifies. When silver breaks $100, and it will possibly this month, the mainstream media will finally cover the story. That triggers the FOMO wave. Millions of retail investors who ignored silver for years will suddenly want in. They'll chase at $105, $110, $115. That creates the second leg of the rally, pushing toward $150. At $150, industrial users will start panicking about supply security. Companies like Tesla, Samsung, solar panel manufacturers, they'll realize they can't wait anymore. They'll start forward buying, locking in supply contracts at any price. That creates the third leg toward $200. And at $200, the narrative shifts from silver is expensive to the dollar is dying. People stop measuring silver in dollar terms and start measuring dollars in silver terms. That's when you know the monetary transition is complete. That's when stage 4 begins and the old system breaks entirely. But between here and there, between $90 and 200 plus, there will be volatility. There will be 15-20% corrections that test your conviction. The banks will engineer sell-offs to try to shake out weak hands one more time. The media will declare the rally over. Your broker will call again urging you to sell, and most retail investors will sell at exactly the wrong time, giving up their positions right before the next leg higher. Don't be that person. Don't let institutional manipulation take your wealth. Don't trust the people who are lying to you on the phone while buying for themselves. Trust the data. Trust the pattern. Trust what BlackRock is doing, not what your broker is saying. I want to close with historical context because this pattern has played out before. Every time a monetary system enters terminal decline, there's a phase where institutions quietly position themselves for the transition while telling the public everything is fine. It happened in Weimar Germany, it happened in Rome, it happened in every currency collapse throughout history. The aristocrats, the merchants, the people with inside information, they converted their wealth into hard assets before the crisis became obvious. They bought land, commodities, gold, silver, and when the currency collapsed, they were the ones who preserved wealth through the transition. The common people who trusted government promises, who believed the official narrative, who sold their hard assets at the urging of authorities, they lost everything. We're in that phase right now. The institutions are positioning. BlackRock is buying billions. Banks are closing shorts at losses. The smart money is moving. The question is, are you moving with them, or are you the exit liquidity they're counting on? This is William Lee. I've shown you what BlackRock is doing. I've explained why banks are closing shorts at massive losses. I've revealed the phone call manipulation tactics they're using to shake you out. I've given you the supply-demand math that guarantees higher prices. And I've warned you about the volatility and the need for responsible position sizing. Now you have to decide. Believe your broker who's calling to tell you to sell while his bank is buying? Or believe the institutions whose actions speak louder than their words? Trust the mainstream narrative that everything is fine, or trust the historical pattern that's repeated dozens of times across thousands of years? The choice is yours. But remember, the institutions already made their choice. They're accumulating. They're closing shorts at losses. They're positioning for what comes next. The only question is whether you figured it out in time. Before you go, remember what I asked at the beginning. Drop a comment and tell me where you're watching from. Let me know if you have questions. I read every comment. I'm here to help you understand what's happening and make better decisions. Stay sharp. Watch what they do, not what they say, and position responsibly for the greatest wealth transfer in modern history. Silver at $90 is not the top. It's barely the beginning. The banks know it. BlackRock knows it. Now you know it too.